It's definitely harder to do it today, I think, than, 20 years ago. I mean, everything just continues to get more competitive. If you want to sit around and wait for the perfect opportunity, like, you'll never find it. I sit on the investment committee for a small charitable foundation here in Austin. It's roughly $55 million. I've never invested in private markets, and there's been an ongoing conversation about how should we think about this? Should we do it now? Is now the right time? And that conversation probably predates me joining the investment committee 2 years ago. So, one of the sayings, I've got a friend in private markets, he says, the best time to plant a tree was 20 years ago. The second best time is today.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
For me, the best part of my podcasting journey has been the opportunity to speak to a huge range of extraordinary investors from all around the world. In this series, I have invited one of them, namely Alan Dunne, to host a series of in-depth conversations on the topic of what it takes to be a world-class allocator. In today's world, portfolio construction is fast moving to the top of the agenda of many investors as they try to analyze and understand the riskiness of their portfolios. And with ever-increasing uncertainty around the globe, being well diversified across many different strategies and themes in your portfolio can mean the difference between ruin and survival when the next crisis emerge. The aim of these conversations is to try and understand the experiences that have influenced these highly specialized allocators and the processes they follow to harness the best returns for their clients so that we can all become better informed investors. And with that, please welcome Alan Dunne.
Thanks very much for that introduction, Niels. Today I'm joined by Chris Schelling. Chris is Chief Investment Strategist at Venturi Private Wealth, an independent wealth management firm based out of Austin, Texas, which manages over $2 billion in assets. Chris has extensive experience as an institutional allocator and more recently as an allocator in the private wealth space. He is a frequent contributor to Institutional Investor magazine, and he is also the author of the book Better Than Alpha. Chris, you're very welcome to the show today.
Hi, Alan. Thanks for having me.
It's an interesting time for you to be joining us here. Obviously, a lot going on in markets and a lot to talk about from an asset allocation perspective. Obviously, you're Chief Investment Strategist at Venturi Private Wealth. Just to set the scene a little bit, can you just tell us a little bit about your background in getting to that position and a little bit about your role as it currently stands?
Sure. I'll tell you a little bit about Venturi and where we're at today. So we're a $2.2 billion wealth management firm headquartered in Austin, Texas, and we work with high net worth and ultra high net worth clients. The firm has been in existence for 6 or 7 years, kind of a background, Merrill Lynch private bank. The partners spun out in 2015 with about $500 million. I joined about a year ago to help build out the alternatives platform, which is an increasingly important kind of competency for, the high net worth and ultra high net worth space. And as you mentioned, was recently promoted to Chief Investment Strategist, which basically means I can now extend some of my investment framework to the entire portfolio and help clients understand how alts solve their needs in a broader portfolio context. But prior to joining Venturi, I had about 20 years in the investment industry, almost all of that in alternatives. The first 10 years or so was in Chicago in a variety of asset management and broker-dealer roles. And then the last 10 prior to joining Venturi, I was an allocator at 2 different large state plans, first in Kentucky and then most recently here in Texas. And at the state institutions, had number of different seats, but all in alternatives and allocated just under $5 billion across private credit, private real assets, private equity, and hedge funds. So excited about the opportunity to take that kind of broad alts background and bring really an institutional kind of scale offering and level of service to our clients.
Interesting. And does that, obviously it presents opportunities, does it present challenges as well in making that transition from the institutional world to the private wealth space?
There's strengths and weaknesses of anything. I think there's a few big key strengths that you get as an institutional allocator that make the transition. Access to some of the best investors on planet Earth, because you're cutting meaningful checks at scale that makes you relevant. And so you're able to really build a network quickly, deploy capital quickly in the institutional space. And that creates that network, that creates that pipeline. I was just on a call yesterday with a top decile private equity fund. It's coming back with their fourth fund. Their minimum is $50 million because they can do that. They have 15 investors and that's it. And so, not that we can necessarily take advantage of that because we're not making $50 million checks, but there's an advantage to having scale. You can negotiate better terms. And so leveraging that framework for clients, I think, is very important. It also makes you somewhat inured to check size, right? I would say our industry is one where lots of people are attracted to the opportunity to just make money for themselves, and having invested billions and billions of dollars for public servants across the country, it makes you less wowed when you sit across the table from somebody who's worth $100 million or $1 billion, because you've done this before. You're very used to managing large pools of capital. And so I think the framework that we're putting in place for sourcing and diligence and selecting managers is very, relevant for our clients, and it'll allow them to take advantage of that. Now, of course, we're not able to cut the same size checks. We're not able to negotiate with kind of brute force, but, having built a network of GPs and having built those relationships and sat on limited partner advisory committees, making yourself a value-added partner to them and showing yourself to be transparent, ethical, and smart is also valuable.
Very good. So I guess it sounds like a lot of the value add that you are going to bring is bringing that, I suppose, quote unquote, institutional grade or institutional level approach to the private wealth space in your current role. I mean, there's probably a couple of different dimensions to it, but from an asset allocation perspective, when you look at how assets are managed in the private wealth space versus the institutional space, what are the obvious differences and where are the potential to add value in that regard?
There's probably more similarities than differences. Certainly, individuals don't have perpetual timeframes, but by and large, they still have very, very long-term time horizons. And I think having sat at institutions that are ostensibly perpetual, whether they will be or not, we'll see, but you're investing over 10, 20, 30, 40 years, and you really get in the mindset of thinking about that as the time horizon, not this year, not even quarters. I think a lot of investors in capital markets are very myopically focused on the short term. So encourage our clients to think, and in many cases it is multi-generational wealth. So putting a framework into kind of simplifying capital appreciation needs, income needs, capital preservation needs. That's kind of all you have as an investor. Those are the three big needs to any investment portfolio. And that's no different than, endowments, foundations, and pensions, frankly.
And I mean, one of the things that, we've become familiar with in the institutional world, and particularly say endowments, you talk about endowments, and you had this idea of the Yale model that became, something that was replicated across many institutions. And part of the challenge for maybe an individual investor is not having the same access to some of the type of opportunities that a big endowment would have. Outside of access, do you think, I suppose, has the adoption of alternative investments more generally been as strong on the private wealth side as the institutional side?
I think that the runway there is greater going forward as far as more adoption coming for individual investors. Right? If you've seen, Yale endowment model kind of led this change in the industry, and really it was 30, almost 40 years ago in many cases for the early adopters. But today, pensions have 25, 35, 40% in alternatives, at least in the U.S. University endowments and foundations are in many cases 45, maybe even 55% alternatives. So that move has already occurred. In the individual space, it's not the case. Mass affluent doesn't have access to the same type of institutional products like you mentioned, but there are liquid alternatives and things. There may be 4 or 5% in alternatives. So almost exclusively traditional public markets. High net worth, 10, 15%, ultra high net worth have more. And when you get to the institutional caliber family offices that are $1 billion family offices, they're run very much like those university endowments that frankly, they sit on the board as benefactors of in many cases. And so what you can see is, and I believe this is the case, that high net worth market segment in the middle is going to be migrating to portfolio construction that looks more like that alts heavy Yale model over the next 10, 20, years. What does that mean for assets? Well, when institutions came into the space, it's $10 trillion worth of wealth they allocated into alternatives. The individual space is the same amount of assets as institutions, 27 trillion or 28 trillion, depending upon kind of what you look at, but it's growing twice as fast. So I think the opportunity there for the next decade or 2 decades is your tens of trillions of dollars. And kind of what I want to do is be involved in making that access to those clients, that institutional grade that you sort of mentioned. In general, I think, Alan, access is kind of overrated in our industry. A lot of people want to sell product and argue that that's the whole value added. I have access to this, I have access to that. Certainly, it is hard to get into some of the best funds out there. But more than access, I think it is finding good managers, right? And then building a portfolio of good managers. And you don't need access to do that. What you need is dedicated resources to just go out and source in a disciplined process.
So it's as much a challenge of resourcing at the private wealth level, in terms of putting good processes in place, as much as access.
I think it's more process than access. I would argue it's more process than access, for sure.
Interesting. Yeah. So you're talking about, this migration, as you call it, into alts that you think is in the works. And I guess, there are structural reasons for that. And then there are macro and valuation reasons why we might expect that as well. Everybody's talking about the end of the 60-40 portfolio, whether you use a 60-40 or not. But I mean, people are saying generally bonds and equities are both fairly richly valued, and people are increasingly, I guess, on the fixed income side in particular, looking for alternatives. As you think about that, and you think about your institutional experience and your alts experience, how do you bring that into formulating a new standard that's going to kind of disrupt the 60-40, and what does that look like?
I think you do have to kind of step back from an asset allocation framework and think about what you're likely to get from various asset classes going forward. So it does kind of have to start top down. Certainly, predictions are very hard to do in our industry, but I think you can find things that are good indicators of probabilities of returns. In equities, it's definitely harder because you're getting a lot more of the total return from changes in valuations and multiples over time. Certainly, earnings growth in public markets over long periods does impact equity returns, and in private markets, it's no different. You're buying on one multiple, hoping to sell at another multiple, and really the only thing you control in between is trying to grow the earnings. But if you look, you mentioned you look at more people leaning into private credit right now. If you look at private credit versus public credit, it's a lot easier to see the difference. I think there's a lot of criticism for institutions for quote unquote reaching for yield and stepping into riskier asset classes like private credit. Well, if you look at senior secured sponsored back private credit direct lending strategies, this is the top of the capital structure, so they're actually higher in terms of, bankruptcy priority than most high yield bonds are. And they're yielding, 300, 400 basis points in excess of what high yield bonds are. So are they riskier? Okay, maybe you have a little bit lower credit quality, but then you're more senior in the capital stack. You certainly have a lot less liquidity. So yeah, you're probably picking up a little bit more risk. But if you're, doubling your yield for 1.2 times the risk, or even 1.5, or some sort of arbitrary measurement of that collective risk profile, you're still enhancing your risk return, asset utilization. So why wouldn't you go make that trade? I mean, I think people are looking at it and going, okay, this is relatively easy to predict those forward returns, even though it's not perfect, right? Maybe you do get some more defaults and lower recoveries than you thought, but it's a pretty big margin of safety. So, that's kind of what our framework looks at, and what we're trying to educate our clients is capital appreciation. Here's what you can get in publics. Here's what you might be able to get in privates. Income. Here's what you get in publics. Here's what you might be able to get in privates. But then it does step back from that top-down framework, and it really requires those bottom-up resources that you mentioned. I think the real key for the Yale model is that bottom-up approach, right? So in my opinion, Yale model is two things. It's a process and it's an outcome. And across the industry, people have looked at the outcome in a lot of cases, but across the industry, people have looked at the outcome and said, let's go naively replicate that, right? 20% private equity, 10% hedge funds, 10% private credit, a little bit real estate, 60-40 or whatever with the remaining publics. And by and large, that's still done fairly well, but that's not what Yale did, right? Yale built the framework by going, this is a really interesting source of returns. These guys and gals here at this private shop, they're doing something that's really compelling. Let's go invest in them. And then they found another one. They just said, wow, these are areas of, relatively attractive returns compared to the risk we're taking. They're not overcapitalized for whatever reason, barriers to entry, regulatory, but let's just go do them and put guardrails around how much we do, rather than have a bullseye, like a target we're shooting for. And the result was a very differentiated and compelling profile. I think you have to marry the two, right? So you start with the framework that says, here's why you do it, but then you go look in more of an unconstrained bottom-up approach for what I call easier games. You find the easier games and then you allocate to them.
And you're right. I mean, I think how you describe it is accurate. That people have looked at the outcome and said, oh, that's something that's worked very well, so let's replicate that. And I suppose the upshot of that has been a flood of money into private equity, people harvesting the illiquidity premium. And then arguably we're seeing this in private credit, private debt, private everything, as you say. And the way you present it there, it seems like a sensible thing to do, a good risk reward. But at the same time, there's another perspective in the back of my mind saying, okay, if all of this money is flooding in, is that a warning sign that, assets flows typically follow returns as opposed to leading it? Is it, we've had a decade of very favorable conditions in terms of low rates, good, decent growth, favorable liquidity. How do you balance that a kind of a macro concern about about a different regime in the next 10 years versus something that seems to have a structural advantage?
It's definitely harder to do it today, I think, than 20 years ago. I mean, everything just continues to get more competitive. If you want to sit around and wait for the perfect opportunity, like, you'll never find it. I sit on the investment committee for a small charitable foundation here in Austin. It's roughly $55 million. I've never invested in private markets, and there's been an ongoing conversation about how should we think about this? Should we do it now? Is now the right time? And that conversation probably predates me joining the investment committee 2 years ago. So, one of the sayings, I've got a friend in private markets. He says, the best time to plant a tree was 20 years ago. The second best time is today. I think it's the same thing in a lot of these asset classes that are still less efficient than, large cap growth stocks in developed markets. I mean, just think about, you've got $1 million, 2 million, maybe 3 million. And that's just professional people engaged in active price discovery on a day-to-day basis in public equities. And in the US, you've got maybe 4,000 public equities where information on all of those companies, their business models, their pricing strategies, it's available almost instantaneously to everybody, so it's great for the transparency of the market, but that means that it's extremely, extremely efficient. You just don't have anything remotely approaching that sort of transparency in private markets yet. Now, to your point, like there's been a flood of money in, and I think the industry has kind of evolved to a series of strata in private markets as opposed to one homogenous thing. And if you look at the bigger end of the markets, the $20 billion funds and up, I think it is relatively more efficient, right? I think the likelihood for returns going forward is compressed. Certainly the dispersion of returns in a lot of those strategies is compressed. However, the smaller end of the market or newer strategies where it's just not quite as competitive. I mean, even private credit, there just doesn't exist, dozens of consultants out there that call themselves private credit specialists, right? You don't necessarily have a pie slice in every institutional asset allocation framework dedicated to private credit. There's maybe $1.2 trillion worth of capital outstanding in private credit, and multiple times that in U.S. munis alone. So you think, high yield bonds, investment grade corporates, asset backed securities, treasuries. I mean, it's 50 plus trillion, and 1.2 trillion of it is private credit. It doesn't feel, even as an asset class, overcapitalized yet.
Yeah, I guess what you say makes sense. I guess the other thing that you do hear about the private markets, which can irk a little bit if you're an operator in the public markets or certain strategies, is that private equity is less risky, because it's not marked so frequently. So it has this advantage. But have you heard that perspective? How would you respond to that?
I don't think people necessarily argue that it's truly less risky. It factually has lower, price volatility. I mean, that's just a function of how you price it. So there are institutions that are happy to have the reduction in their portfolio level vol that comes from a larger allocation to private markets. I don't think they're naive enough to say that it's really lower risk, right? But there's a behavioral component to risk where when you're in the middle of a drawdown, decisions change in ways that you didn't necessarily think they were going to change going into the drawdown. And so not having that drawdown can be helpful, particularly if the decision makers are not the same constituencies as the professionals, right? So it's like they put that in there because they realize it's going to have that added ancillary benefit. I think you shouldn't do it just for that alone, of course. And fundamentally, the real risk in any equity is that the business goes away, right? It goes to zero, or you sell it. You have to sell it for a substantial loss, right? It's capital impairment. That's the real risk. So I don't think it's lower risk per se. Now I think there are areas of private equity that are higher risk and lower risk than others. And I think that's also true. Yeah.
I guess another perspective before we leave this space is the value of the liquidity. And, I suppose, are we at a point where possible complacency around that thing that people say, oh, well, I don't need the liquidity really, and you don't need it until you do need it. And, part of the behavioral possible advantage of private equity is the pre-commitment, and you don't have the option to review these allocations unless you sell out into the secondary market, which generally is a very unfavorable outcome. But how very tricky to try and assess, but is liquidity being less valued at the moment than it should be or not? Or do you think it's about right?
I think liquidity is the key here. It's also an interesting risk premium to think about. In some ways, it's kind of like the equity risk premium. I think thinking about liquidity as a risk premium is somewhat naive because you're not generating returns from liquidity or illiquidity per se, right? What the liquidity does is it reduces the number of transactions, which reduces pricing efficiency, which means you're either able to get a wider bid-ask spread, pick up more value, get a higher yield, and that's where your actual return comes from. So it means the market is just less efficient. You buy your house, you sell your house, you don't make money from illiquidity in your house, right? Someone pays more for it. It's a cap rate or something that goes up or down. So I try not to think of like liquidity as what drives returns. It is, however, a risk. And I think it's what really should drive the conversation with clients around how much to allocate. That's the key component. Like, do not think you can get access to this money for 10 years, period. First, start with that. Now, true perpetual institutions don't need access to everything for 10 years. And it's also how I frame kind of some of the conversation with this charitable foundation. It's like we've got 70% in public equities. How much of that have we actually had to liquidate and sell over the course of the last decade? Well, virtually none. Right? So if you know what your spending is, and it's mathematically spelled out, over the next decade, pretty clearly, it doesn't seem to me to be a pretty significant risk to put 10 or 15 or 20% of that into an illiquid asset. Now, you also bring up an interesting point. There's optionality in liquidity, i.e., I can buy at the right time, I can sell at the right time. But behavioral research shows that that's not what people, even professionals like you and I, tend to do. We tend to do the opposite. We buy high and sell low. It's muted for professionals compared to individuals, but it's still there. I think part of the value of private markets is that it does kind of lock that up. It takes some of the emotional and subjectivity out of the decision making, and you can really look at long-term plans. Right. The decision to sell a company in private markets isn't something that's based upon a quarterly drawdown in the S&P 500. It's like a 6-month process minimum to take something to market. And so you're really planning this a year or 2 years in advance, and it's driven by operating metrics at the company, right? As opposed to you can try to be a little bit tactical and say there's a ton of demand for this sector right now, valuations are high now, let's sell it. But by and large, I think taking the subjectivity and the emotion out of it is the value of the optionality, or the loss of optionality really in illiquidity.
Okay, so maybe shifting within the alt space, but into the more liquid alts. And obviously you've had experience of allocating across both sides. And I know in your book you talk about kind of, I suppose, alpha and the erosion of alpha over time, and you have a categorization of different types of betas and alphas within the investment universe, from kind of beta to smart beta to different types of alpha to pure alpha. I mean, and which kind of mirrors what you see in the industry as well. You have all of these labels like smart beta, alternative risk premia, alternative alpha, style premia. Do you think these labels are helpful, or are they just something that kind of helps map different strategies into different fee structures? Or how do you think about the mapping different strategies into different categories like that?
I mean, I think the industry is nothing if not great at creating product where there is demand. So, we've got 450 different factors now. There's probably only a handful of them that are really meaningful. The rest of them are either statistical anomalies or like trading strategies, right? They're not really durable factors. What drives returns in the long run for an asset is value, growth, and income. That's really just about it. You sell an asset for more than you pay for it, and you get distributions of some kind along the way. So to me, mapping durable factors to those real risk premium is where the value is. I think what a lot of liquid alts or various risk premium strategies are today are systematic implementations of hedge fund strategies from 20 years ago. Right. And if you track the migration of the industry, that's literally what happens. It's a lot of people that grew up on bank desks They learned a trading strategy. Not everyone was doing it. They went out and launched a hedge fund around that strategy, was successful. They hired more people. More people learned how to do it. More people launched their hedge funds, and eventually it became much more efficient. And so, merger arbitrage, well, you can just go buy every merger spread that's listed out there right now and just systematically implement that. Is that a hedge fund anymore? Is that a risk premium strategy? Is that something you can make available in an ETF or a mutual fund? I mean, it's kind of arguably all of the above. So the framework that I think about, alpha to beta is if there's research written about it, academics know about it, lots of products available, right? You can buy it for 50 basis points in a 40 act type strategy. Then it looks a lot more like beta. I mean, even the S&P 500 is a trading strategy, right? I mean, it's just, here's the stocks, here's how you own them, here's when you sell them, and here's when you buy different ones. So yeah, I mean, I think it's important to really understand the value you're getting and price it appropriately. That's where the framework becomes helpful to me. Like, is this something that anybody can go replicate? Could I hire an execution trader and staff it and do it ourselves? Because if you can, then it's not alpha anymore. The same thing is occurring in private markets, by the way. I like to give grief to the big funds, but the reality is they're incredibly resourced with just loads of brilliant people, and they have, Vista has what they call the Vista Standard Operating Procedures, VSOP, which is like a library full of value creation steps. I mean, it's literally like McKinsey or Bain level consulting stuff. They're brilliant at that in software businesses. They are also large, and they have to look at a company of a certain size for them to go implement that framework. Now, if you go down market, obviously, they don't have the same level of resources. And as you get smaller and smaller, it's less. That's just a function of scale. But today, I'd argue that those smaller funds are probably, more competitive than they were 20 years ago, because that knowledge is out there and it's filtering down. And oftentimes, many of those small fund startups came from the larger funds. And so they bring a lot of that institutional knowledge with them. And so they're doing things that look like, value creation stuff that the big funds alone would have been able to do 20 years ago. And it's this a continual migration of knowledge from alpha down to beta. I have a GP friend who put it to me very succinctly. He said, we've got to keep getting better faster than the market gets more efficient.
You also talk a lot about in your book, within different strategies about, the dispersion of returns and persistence of returns. And would it be fair to say that in less beta strategies, you're going to get more dispersion? That's
the real risk, right? That's the real risk is a broader dispersion of returns.
Yeah.
Is the average slightly higher or slightly lower? It's difficult to say. And there's probably a lot of backfill bias, survivorship bias, particularly in the small and emerging manager parts of these indices, right? Hedge fund indices, private equity, because that's where the blowups and the people going out of business quickly happens. But if you can actually select from above median, you get paid for it. It's quite literally shooting at a bigger bullseye. And I do think in private markets, there are things that you can look to ex ante that are more predictive of persistence of performance ex post. So again, it's not perfect, but I think the odds can tilt in your favor there.
The whole area of, these style premia and factors, it was very much to the fore, I would say, maybe going back 4 or 5 years ago. And, particularly from my background in managed futures and trend following, you were hearing the argument, trend following is just a beta exposure. So I'm not going to pay for that type of exposure. And, I can go to an investment bank and get them. They have these, equivalent strategies off the shelf, and I can just get it with a swap. And, we disagreed with that perspective for various reasons. And it seems like alternative risk premia had a tough period, I think, in 2020, and I hear less about them now and more kind of acceptance of maybe premium approaches within the managed future space. Is that an example of where there was a misperception that just because something might be something that you could do yourself, it doesn't necessarily mean that everybody is doing it exactly the same?
Now you bring up a good point. Implementation is certainly key, and not just in trend, but even in value. What's the specific metric that actually captures value? Anybody can see, right? I'm getting $1 for 80 cents, like trading with, a kid.
Yes.
And that's easy to do, but actually measuring it in the framework of a corporate capital structure that's very complex. Implementation matters. Trend is an interesting one to think about because it's not necessarily intrinsic to the asset itself. Right. Value is in the asset. Yield is in the asset. Trend is really a function of market participant behavior and willingness to continue to pay a higher multiple or a lower yield on something in the future. And I would say that makes the implementation even more critical, right? Because what's the right measurement of it? What's the right periodicity of it? How do you do those things? So it's certainly no trivial. It's no trivial factor to go try and do it yourself. I think that's part of the challenging thing of liquid alts is how they actually implement a lot of those things impacts the market itself, right? And then you've got to adapt and adjust. So yeah, it's not by no means do I think I have all the answers. I think it's hard to try to do a lot of this stuff yourself.
Absolutely. And I mean, one of the things that we're talking about is the persistence and dispersion, and dispersion of performance has always been a high in the managed future space. So kind of reflecting that kind of the difference of approaches across different managers. You talk about a lot of different alphas in your book, process alpha is one of them. And I guess what you're getting at is while there might be an erosion of alpha across certain strategies, there is still the potential of the allocator to cultivate their own alpha in their processes. And we'd had previous guest on, Phil Huber, I think it was, we were talking about cultivating a behavioral edge or a behavioral alpha. So it's kind of to the same mindset that, okay, while there might be some compression of risk premium in markets, there's still a lot of potential to add value as a portfolio constructor and as an asset allocator. Is that fair to say?
Yeah, I completely agree with that. I mean, I think it even starts one layer above behavioral alpha. So I talk about organizational alpha or smart governance. And, that's part of what I'm doing now is in my new role is helping clients think about what their objectives are. You start at the top and you really have to set and describe those objectives. And then that determines what your time horizon is. And your time horizon helps to frame what risk really means, right? If you're saving cash for a down payment on a house in 6 months, that's a different definition of risk than if you are mid-career saving for retirement, trying to build future wealth for next generations. That risks should not be the same. You shouldn't just use volatility for measuring risk in both. So when you set aside the time to really describe your policy objectives, to describe your time horizons, your risk, it helps frame better decisions. And frankly, in an institutional setting, mapping out who makes which decisions is super critical. The endowment model we keep talking about, I think in a lot of cases, people just systematically implemented the output without an understanding for what resources and decision-making frameworks were needed to go manage that, right? You shouldn't be trying to pick hedge funds if you don't have anybody on staff with that competency, if you don't have the ability to, underwrite complex limited partnership documents and subscription documents and manage all those things. Same thing with private equity. You shouldn't try to do it if you can't manage commitments, cash flows, all those things. So really putting the decision-making framework in place first to allow you to then go make those decisions better is super critical. And then when you do that, it's all about managing your behaviors. And process is what allows you to do that. Like the more time I spend, in alternatives, the more I realize process is really driving everything. I got into an argument with a friend of mine who's building a crypto hedge fund.
Oh yeah.
About does alpha come from process or is it really just from great ideas? And as we debated both sides of the arguments, I think he came to realize like what I'm saying is how you come up with those ideas consistently in a repeatable, replicable way is only due to process. Now, it may occur inside your head and no one has transparency into how that works. Now, over time, I'd say that's not the best, most persistent approach to alpha generation, but there's certainly process. There's things going on where you're identifying something, you're vetting it, researching it, and you're ultimately making a decision. The more you can standardize that, the better.
And I mean, that sounds very sensible. And, I suppose one of the things that strikes me, I know in your book you write a lot about behavioral biases, and it's a topic of interest for me with kind of my manager selection background. What I find is everybody reads Daniel Kahneman's book and says it's so interesting, and I recognize that heuristic and bias, and it's easy to talk about these things at an intellectual level between you and I here and now, but it's at that point when you're making the allocation decision that being aware that there may be part of your decision making might be being influenced by some of these biases is much more difficult. How do you go overcome that in terms of what does it look like in terms of good process to overcome those biases?
Yeah, it's impossible to get rid of them completely. I mean, we are all human animals, and that's just how our brains have evolved to make decisions. It was built for a simple, ecology, and we're in a very complex information economy. I think one of the most important things is simply repetition, right? Pattern recognition is more effective with more data points. So when meeting managers, what does that mean? Well, try to meet 100 in a strategy instead of 10. Number one, you're not going to be so biased as the first 2 or 3 managers that you meet.
Yes,
right? You're going to be, frankly, a little more jaded after 90. But we all have a tendency when we see something kind of new, it's interesting, it's exciting, and we like people more after we have a chance to sit down and talk to them. So you meet your first hedge fund, you walk out of there, wow, they're geniuses. This is fantastic. Well, go meet 100 more. Right? That's probably the simplest way to do it. You start to see, well, everybody does this, right? There's a lot of other people out there doing the same thing. And then you also see the bad funds. So take some bad meetings, because you'll start to see, oh, this shop is great, they do it this way. This one's great, they do it this way. And then you see one that's got some really weak numbers, and turns out they don't do it that way. Now maybe you've identified something that really is important. So just repetition is super important. Quantify things as much as you can, right? Takes the subjectivity out of it. Now it's, again, easier said than done. I've used personality profiles for a number of years to sit down with GPs and say, we take this test. It's 45 minutes roughly, right? Measures how they think. So there's an aptitude component, verbal and mathematics, and then there's just 12 different spectra of decision making. Are they analytical?
What are you looking for in that?
So it's again just a way to quantify how they actually do it, because we walk out of a room and we have our impressions, right? We have our biases. That person's smart, or she really knows what she's talking about, or she's very analytical and he seems to be very decisive. Well, this literally puts a mathematical framework around that, but then it also scores them. There's millions of respondents that are in the investment industry that it kind of benchmarks them to, and it gives you some interesting questions to ask as well. So it does give you quantitative output where you can walk out of the room and go, all right, I think they're like this, let's go look. But it also helps you, if there's 2 partners and they both score very, very low on the sociability spectrum, well, how do you source new deal flow? Like, you've got to be out there meeting with CEOs and executives. How do you go about that? Because you both score low on this, which means you might not enjoy that.
Yes,
I've had that conversation. They come back and say, no, that's true. Here's how we've had to systematize it, so we make ourselves do it in a disciplined framework. Right. So quantifying as much as you can, I think, takes a lot of the subjectivity and the bias out of it.
What about the randomness, which is the thing that everybody struggles with, that when you get tough performance, is it just due to chance, or is there something structural? And it's one of the big things where, again, you touch on in your book, the Michael Mabussan framework, the luck, skill, where you are, how much luck, how much skill. And there is plenty of randomness and luck over shorter time periods in the investment world. And that can be difficult. And I would have thought it's even more difficult in the private wealth space when you're speaking to clients, because we're so conditioned with when performance is poor, well, what are you doing about it? What is that person doing about it? If the answer is nothing, that's rarely, satisfactory from a client perspective. You say, well, they're not doing anything because we just sampled that side of the distribution. So how do you, get people comfortable with this idea that there will be tough periods just by chance and it doesn't necessarily mean anything?
Yeah, that's a big part of it. And it's not, I actually think that there's an interesting parallel between the wealth space and the institutional space in that the constituencies are somewhat similar. I'm in a lot of cases just translating what I've done with my boards to my clients because they're similar demographics, right? They're successful business people, and just getting them to extend their time horizon in a lot of cases. The market's down or whatever, or managers having a drawdown. Well, if your diligence said this is literally within, one standard deviation of expected drawdown or something, they're prepared for it. It's setting expectations better. It takes time. It's not like you can snap your finger, but you've got to condition them to think longer terms. A friend of mine, also a very good author, his name's Brian Portnoy, runs a firm called Shaping Wealth. Brian has said success in investments means ensuring outcomes meet expectations. And I love that framework, right? Because you can't really control outcomes. You can put process in place, right? And you may be able to find things that are predictive of those outcomes, but ultimately there's randomness.
Yeah.
But you can manage expectations, right?
Yes.
So doing everything you can to ahead of time say, hey, this is totally expected. When this happens, we're going to do nothing because this is completely in the frame. Now, the other point that I want to make is that controlling randomness, you have to have appropriate diversification.
Yeah.
So there's a ton of research that shows what's the right number of managers. If you're going to build a portfolio of hedge funds, to me, 2 or 3 is kind of crazy. Or same thing with private equity. If you're going to do 1 or 2 private equity funds, there's so much randomness inherent in a single fund that's a very uncomfortable position. Now, I've come from institutions where we had 180 limited partnerships, and that's more a function of scale than probably the right number. But it seems to me, 5 to 10 is pretty prudent. And so diversifying your exposure and alternatives is also important.
Okay. You talk about, in the whole process of picking managers and, I think you have 5 Ps in your book in terms of your criteria, which is, I think, quite similar to I think Morningstar have 4 Ps, if I'm not mistaken. So it's similar kind of mindset. And you have 3 Is in terms of managers as well: intelligence and integrity and intensity. And it is difficult, as you say, if you meet 100 different hedge funds, that you'll meet a lot of impressive people there, and a lot of people will probably tick the boxes from your framework perspective. If you were to try and boil it down to these factors, when you're looking at different managers, what are the really big things that you need to see to be comfortable with allocating to a manager?
I mean, we all, the 5 Ps, everyone starts with performance. So back to the biases, like just acknowledge that rather than fight it. But what I try to do is just eliminate where there's no evidence of good performance. Like, why would you spend the time to get to know those managers? So you start with a subset of managers that have good performance, but I think the most important 2 factors are people and process. And back, to that framework of like alpha at the top of the pyramid and a whole spectra of different types of returns in between, and then pure beta down at the bottom. The closer you are to that alpha, the more important the people become. The closer you are to that beta, the more important the process becomes. And so as you start to understand what they're doing, you tilt your diligence to focus on those most important factors. I mean, if they've gotten, a ton of discretion, the strategy is really unique, it's something that you haven't seen or heard before, and you've tried to find those 100 managers, well, the people are going to be super critical to ensuring that continues. Here, an interesting stat in private markets, the people on a deal are 4 to 5 times more predictive of future returns than the brand on the company of the deal. So that is, if it's XYZ fund or ABC fund, that doesn't matter as much as if it's Joe or Sally. 4 to 5 times as much predictability in the person. So I think in those strategies, getting to know how those people make decisions, right, which is where the personality profile gives us an edge. We really have insight into how do the two of them work together. Who's the person that's very analytical? Who's the that's super critical. But then process becomes more and more critical the more systematic and standardized the investment is.
And so, in the whole domain of quant strategies and systematic strategies, what do you look for from a process perspective to get comfort in that regard?
So that's an interesting one. Is the model currently in its implementation, is that the process, or is it about the process to test, measure, refine, and implement signals going forward? I tend to think that for many types of quant strategies, what people think of quant in hedge fund space is geniuses in a back room running computer programs.
Yeah.
Well, how do they actually go about finding the signals? Is their process appear to have a lot of data mining and sampling bias and all sorts of things that result in great back-tested numbers, but not so much replicability to the real world. What do they do when a signal stops working? How disciplined are they about killing that? When's the last signal that they killed? Why? How did it work? What's their process for adding new signals? Do they test it in some kind of beta framework? Do they add it at a certain weighting and then raise those weightings over time? So again, I think it kind of becomes more about the process for refining and enhancing the model over time than what's in the, what's underneath the hood today. I think people really try to get too deep into those. It is truly a black box, right? You're not going to completely understand that. They may not even completely understand it themselves, frankly. But figuring out how they go about managing that's going to give, to me, that's more signal, less noise.
And it's interesting because you're talking about how systematic strategies there's this perception of the model that I'm investing in, but ultimately it was developed by a human and
by people.
That the people had to make decisions along the way, like, okay, how are we going to allocate risk? Which markets are we going to trade? Which markets are we not going to trade? What will we do in a drawdown? When will we add more markets? All of those things. So curious, have you asked people running systematic strategies to do your personality profile and anything different come out of those profiles versus what you see in more conventional, I suppose, discretionary managers?
That's a good question, actually. I think this is the first time I've been asked that. I don't think I've ever given it to a quant manager. I would guess they'll score off the charts on mathematical competencies. That would be the first. Yes. You'd at least want that, right? If they scored really poorly on that would be a big red flag.
Yes. Yeah. Well, no, but going back to your profile, you don't necessarily need your quant manager to be good at going out and meeting
exactly
CEOs. That's not part of it. But there is still that subjective. They still have to be able to manage risk through the cycle, and when the pressure comes on in a drawdown, there might be a temptation to tinker with the model or to add models, remove models, and that's where I suppose there's that parallel between the typical discretionary manager and the quant manager.
Totally. You never get away from human discretion or judgment in investing. You just can't. You can't complete. And frankly, I think that's a good thing. But how do you assess what they're likely to do in that environment? Well, past performance is no predictor of future results. That's beaten into our heads as investment professionals our entire career. But my undergrad is in psychology. And past behavior is, in fact, a very good predictor of future behavior. So if they've tended to behave, this way in this environment in the past, it's a good indicator that they will probably engage in that same behavior in the future. There's just this inherent, everybody wants a 3-year track record. And why? Well, no one really knows why. But I think that's part of it, because we want to see evidence of behavior across the cycle, because then we can say, well, how are we going to set our expectations about their behavior in that same environment in the future?
Is that a typical time frame you would look at? I mean, it strikes me that 2 to 3 years is very typical in the market for evaluating managers, but actually, it's not a very long term perspective. I mean, if you say long term to people, they often think, for some people it's 2 to 3 years, maybe 5 years. For some other people, it's 100 years. So, within 2 to 3 years, you can have very similar macro market environment that's not really telling you a whole lot about how a manager might operate in a very different market environment. What do you think is the right time frame to be analyzing managers over?
I mean, as long as possible. I mean, that 2 to 3 number, I don't think it's been intentionally set by anyone. I think it's just the result of what a lot of institutions look for, a lot of consultants look for, and there's just this unintentional sort of consensus that number makes sense. And what I love to see is 10 years worth of like pre-fund track record, right? Where you can get really good insight into what this manager actually did with real money somewhere else. Now you've got to be certain about that attribution, but it might even be a day one launch or only 18 months worth of performance under the current brand. But if what they've done is repeatable and replicable and there's evidence of it across a cycle, and I think it's even more important today because cycles just appear to be extended, right? Because of, unconventional types and amounts of central bank stimulus across the globe. Like they just are longer cycles. And so, yeah, I like to see as much as I can, 10, 15 years pre-fund and then couple quarters. I've done quite a few fund ones in my career. And I think there's also a lot of research that shows fund ones now outperform. And I think if you condition that fund one performance on the pre-fund track record, right, that likelihood goes way higher. And that's why, because you're actually getting that evidence of persistence of performance ahead of making that decision.
I mean, that's ideally a great place to be when you have that level of data. Very often you don't have that in that pure form. Like you may have...
It's usually messy.
Yeah, a manager spinning out of a bank or another firm or whatever it is, and you have to draw some inferences. And then it's a matter, well, do they have the same infrastructure around them or not? So it can be difficult to wait for kind of that setup, isn't it?
Completely. Right? It's almost, you never find perfect. Like it's almost never perfect. You wind up with was the value in the seat or was the value, in the trader. In private markets, same thing. Is their sourcing going to translate, right? Was it actually them leading the deals? So you never have perfect, but that's where the diligence actually comes in, right? Check the box on, a big manager that's on fund 12 where you're talking to existing LPs. Like there's not a lot of value in that. Doing diligence to actually figure out those opportunities where there's more, apparent hair and things keeping other LPs away. That's where there's value. It's arbitraging the difference between the perception of risk and actual risk.
And, a big part of your work has been on due diligence process, etc. And it's interesting you reference a study in your book about how the number of hours performed on due diligence, correlated with the outcomes in terms of, better and deeper due diligence result in better outcomes, which makes sense. Equally, there can be a temptation, we have our due diligence team, we'll tick all the boxes, we'll do all the quant analysis, and you could, nearly even engineer the outcome that you want. We have a predisposition towards this manager, let's do the process, and that's the outcome you get. What are the 2 or 3 things you really need to avoid or do to make it a good due diligence process, would you say?
To me, the most important one is like intellectual honesty or a scientific, process, whichever one you prefer. But they're very similar. It means instead of looking for confirmatory evidence, right, you need to find things to disconfirm your hypothesis. I mean, that's kind of what science, how it works. You never prove anything, but you show a ton of evidence that is consistent, and the alternate explanations don't cover all the evidence, right, as elegantly. Right? It's like the paradigm of Occam's razor. So, but also being willing to kill your own ideas. Right? That's that intellectual honesty. Like you've got to be the first one to stand up and say, I was wrong. So I think those are the key things. Now, it helps to see tons and tons of managers because you just don't get married to any of them as much. Now, everyone wants deep relationships with a few managers. You don't just leapfrog right to that. You have to get to there. And so meeting, frankly, thousands of managers is super helpful in developing that kind of dispassionate approach. So yeah, to me, that's the most important one. And you've still got to be willing to kill something right at the finish line. So I've taken things through an investment committee, gotten board approval, consultant diligence on them, all our stuff is done, and we did not close on it because of a few things in confirmatory due diligence. If you're not willing to do that, then to your point, you've already sort of preordained the outcome.
You use sort of dispassionate approach, which is an interesting one, because when you talk about things that you look for intelligence, integrity, intensity. I mean, with manager selection, is there a risk of being biased towards people you meet that are similar to yourself or you're on the same wavelength? How do you deal with that possibility that you think, okay, or this feels good as an allocator, but it might just be that it's something that is, triggering one of your own biases?
So I think the actual risk of manager selection is not something that we can quantify in a single dimension, 2-dimension, 3-dimension. Honestly, it's this complex series of risk profiles. And to really hedge against any of those biases, because as I said before, you like people more after you meet them. You like people that are like yourself. That's a natural tendency for all people, is by consciously diversifying across those things. So we talk about diverse managers. I think that's important to do because you're getting different approaches. So when I meet managers, I want not just different sectors, not just different strategies. I'm willing to say, like, fund ones, there's more risk. It's not always the best. So let's maybe have a fund 7, right? I'm willing to say small is nichier, cooler, maybe better return, but let's have a couple of bigger funds, right? Let's have people who score differently on these things. Let's have, so at Texas Municipal, which was my most recent stop, it was a $3 billion private equity portfolio. A third of the portfolio was funds 1, 2, and 3. But I had no mandate to do that, right? And a fifth of the portfolio was women and diverse managers. Again, had no mandate to do that. But it's specifically because I believe, you've got to hedge your own personal biases. And when you find somebody that ticks like 3 or 4 or 6 or 7 or 8 other boxes, but don't have these 1 or 2 things that you're like, wow, I think that's really important. Well, then you hedge that.
Yeah. So it's interesting. It's all about humility by the sounds of it, and recognizing that it's manager selection is very difficult, and you have to hedge, or not so much hedge, but diversify from the risk, diversify the risk that your own selection may be biased.
Right. Yeah. And so that means you have people who do just stuff differently, but there has to be research around why that stuff is maybe a better way. It can't just be, a gut approach.
Yeah. It's interesting. I mean, you talk a lot about repetition, which is true. And I guess it's one of those things that you want to, if you want to get good at anything, it's a bit like the 10,000 hours idea. This, it's kind of like practice with feedback is the idea that you want. Now, the problem with obviously something like hedge fund selection is the feedback can be relatively slow, or it's not a perfect signal, because you can make a selection and you might be right, but right for the wrong reason, or you might be, you might have just been unfortunate with your timing. How many years experience do you think you need to be doing this to really feel it? Or what was your own experience? Like, after how long did you feel, okay, I'm getting better at this, I'm getting more skilled? Or do you still think it's a work in progress?
I still think it's a work in progress, but it all comes down to how unambiguous is the signal, right? And how rapid is the feedback, right? When it's kind of an ambiguous signal and when the feedback is very slow, it takes a lot longer and you need a lot more repetition. But that's precisely what you see in private markets and hedge funds, is that the signal is sometimes ambiguous because maybe you did get it right. Maybe they just had bad luck, or maybe you got it right for the wrong reasons, So there's all sorts of ways where it's difficult to assess. Doing postmortems, even looking for things that you missed that still worked out and understanding why you missed them. It's okay to miss good opportunities for the right reasons too. And then just repetition, and years. I think that's a huge advantage, frankly. There's so many good institutional allocators out there that are moving into the wealth space, moving into family offices that have 10 or 20 year track records individually in the space and have learned all that knowledge institutionally. That's just something that's difficult to build from scratch, because it takes, I think 5 to 10 years. It takes 5 to 10 years.
Yeah, absolutely. Great. It's been fascinating getting all of these insights. We could go on for another hour, I think, on behavioral biases alone. From your own journey, moving from, you've done a bunch of different things as a consultant, working in the public space, working on the wealth management side, to where you are now as a chief investment strategist. What would your advice be for people, wanting to develop their careers and to work in asset allocation and manager selection? Obviously, it sounds like meet a lot of managers is one obvious takeaway from our conversation today. Any other tips and suggestions?
I think building your network, and be willing to change. Change positions, change roles, change sectors, change asset classes, change jobs, change companies. Just be willing to move around and take a shot. Public pensions they're not the most highly compensated job in the industry, but again, you can build that network really rapidly there. You can meet people and allocate capital and move around very quickly. So I think they're a good opportunity for people wanting to move into alts for sure.
Very good. Obviously, you have your own book, Better Than Alpha, which I definitely recommend, particularly in relation to the whole skills of manager selection and the challenges of behavioral biases and building processes. Any other books that you would have on your reading list for people to look at as they build skills in these areas?
Well, you mentioned Phil Huber. He's got The Allocator's Edge, which is a tome of research of how to use every alternative in a portfolio context. I mentioned Brian Portnoy, a good friend of mine. He's written Investor's Paradox on how to pick managers, and then The Geometry of Wealth on how to kind of frame investment objectives and think about making outcomes meet expectations. So both very behaviorally informed investors as well.
Good stuff. Well, thanks very much for coming on the podcast, Chris. It's been a pleasure having you on. We've really covered a lot of ground.
Yeah.
I've learned a lot. So thanks very much.
Thanks for having me, Alan. I really enjoyed the conversation.
Great. And with that, I'll pass it back to Niels.
Thank you so much, Alan and Chris, for a wonderful conversation where you managed to cover quite a lot of ground. Some of the things that stood out for me was really this idea that even if past performance is not indicative of future returns, past behavior is often a very good indicator of future behavior. I also found Chris's view on what makes a sound due diligence process and the willingness to disprove your own thesis and biases as an allocator, and how you can define success with your clients as outcome meeting with expectations, as Brian Portnoy says. So I hope you were able to take lots of inspiration away from today's conversation. Make sure you go and get Chris's book, Better Than Alpha, and follow both Chris and Alan on social media, because as you can tell from today's conversation, it is so important that you understand how to construct a well-diversified portfolio, and we really look forward to sharing many more of these insights as our series continue. From Alan and me, thanks so much for listening, and we look forward to being back with you on the next episode. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.